This is ESG Decoded, the podcast powered by ClimeCo to provide relevant, actionable updates related to business innovation and sustainability. Join Caitlin Allen and Amanda Hsieh of ClimeCo for thoughtful, nuanced conversations with industry leaders that explore the complexities, the risks, and the opportunities connected to all things ESG. I'm Yvonne Harris, a consultant and a co-host, and I will be collaborating with Caitlin and Amanda for the discussions that we will present on this podcast. Put simply, ESG is everything that's not on your balance sheet. This leaves room for misunderstanding, oversimplification, and the tendency towards one-size-fits-all perspectives. None of that will happen on this podcast. Enjoy this episode.
Hi, everyone. Welcome back to ESG Decoded. This is Amanda Hsieh. And today I have the pleasure of talking to James Rasteh, the founding partner at Coast Capital. James was recently named one of the top hedge fund managers to watch in 2022 by Business Insider. And if his name sounds familiar, you may have seen James on CNBC or Bloomberg News. Coast Capital is a fund that takes a PE approach to investing in public companies, and we're going to kind of delve into that with James today. And I think this could not be a more timely topic with all the interest in ESG investing nowadays. It's such a big, broad term, and I feel like every week I'm seeing some kind of article in Wall Street Journal or posted on LinkedIn about what it is and what it isn't. And so I'm really excited to be talking to James Rasteh. He's really a leader in this space. James, thank you so much for joining me today.
Pleasure to be with you.
I'd love if you could start off and tell just folks a little bit about Coast Capital and your approach to investing and your investment theories.
Yeah. So Coast Capital is a fund which takes, as you say, a private equity approach to investing in public companies. What we do is we look for and invest in companies that, in our estimation, are leaders in profitable and growing industries. And we invest in these companies when they are dramatically undervalued compared with peers in history and fair value, and have events to release value back to investors. So we look for a confluence of three factors, corporate gem, leader in a profitable and growing industry, really low valuations, events to release value back to investors. Being very actively minded in I think all facets of my personal and professional life, we often are the event that releases value back to investors. We are activist investors. That I think is partly reflective of the fact that prior to starting our own fund, I was at a firm called JANA Partners, which is one of the big activist funds in New York, and had a wonderful time working with the founder, Barry, at that firm. But we are part of the event. And the thing that we do that is different from what I have done historically, but that is really an integral part of our process, is we have an advisory board that we've been working with, frankly, for over a decade. But we have these advisors who are leading CEOs and operating experts from the industries that we invest in. And when we invest in a company, we identify an advisor who knows that company and that industry intimately well, has an extraordinary track record of creating value in that company or that industry. And these advisors do our operational due diligence for us. And if you think about the fact that we invest in really great companies that have low valuations, the only way that happens, or the only way you find such companies, is when they are undermanaged in some way or misallocating capital. But there's usually the great, wide world thinks there's some kind of a problem usually with the companies that we invest in. And we come in when that problem is being solved. And very often with the help of our advisors, we actually solve those problems and create value for our investors. So I've had the good fortune to work at a number of hedge funds that were seen as best in class and had the best performance in their respective strategies for a number of years. And this process is intellectually super rewarding, super engaging, super fun. And very, very thankfully, even though we don't care about our short-term returns, we really are long-term multi-year investors. I think that, the performance is some of the best that I've been able to create over my career. So that's the cherry on top of the whipped cream on top of the ice cream.
That's awesome. How does ESG investing come into play with your approach then?
ESG is very personal to me. And as I think about it, I cannot help but think that it should be very personal to any practicant of it, and I think that it isn't. And I think that's a big part of the problem. So a number of years ago, I wrote an article. I'm Canadian, and the Globe and Mail is sort of our New York Times up in Canada. So I wrote an article, I forget the title, but it was like something like the ESG investment industry is broken. I really felt that most of the practicant and the funds that profess to be ESG really are not. And I cannot help but feel that a lot of individuals who market these funds were, forgive me, charlatans, for lack of a better word, because I think that there is such an important responsibility that we as lead investors in publicly quoted companies have to set these companies on the right path in terms of decreasing their environmental impact or improving their community relations or improving their corporate governance. And the fact that the largest ESG fund in 2016, which was Al Gore's Generation Fund, their largest investment was in Facebook. Because Facebook doesn't have much carbon emission and therefore it was seen as an ESG play. But Facebook has done more to destabilize democracy in the Western world and to bring depression onto teens and to hide its nefarious practices from the clients and investor base. It's like one of the most wicked companies ever. And to invest in that as an ESG fund, I think is so emblematic of the underlying problems and inconsistencies and I think philosophical shortcomings in the ESG industry. So for me, ESG, kind of starts at home. Investing with an ESG focus should only be done by people who actually personally really care, because otherwise it's like starting a restaurant, but the head chef doesn't really like to cook. They just think that it makes sense to build a restaurant. And I think that most of these ESG restaurants, these ESG funds, if we were to, compare them to restaurants, are led probably by, chefs who don't like to cook. I mean, they're not portfolio managers who, have a track record of doing volunteer work in their communities. They're not on the boards of agencies that, look after environmental well-being in local communities or whatever. They don't do that. It's kind of like a marketing effort. And to me, it seems obvious that it all starts with the manager, and it starts with passion on behalf of the manager to, I hate to sound trite, but to improve the world in their own way and to fix mistakes that corporations are making or to erase the deleterious impact of communication of corporations on their local communities. So for me, it starts with the manager. My parents put me in a school in Canada where, I did a program called IB, which I think is like the best program ever for a high school student, better than AP. And as part of that, we had to do volunteer work. Every week, we had to do 2 weeks of volunteer work. And I hated it. And I didn't see the point. No kid wants to do that. But, I started volunteering at hospitals. I started volunteering at, basically going in, cleaning up parks. And after you do that for a couple of years, you understand this is actually really important work. And you actually pay attention to, people's welfare and parks being clean and environmental awareness. And I went to a whole bunch of like youth for environmental awareness conferences when I was a teen and really got involved with that. And you can't help your wiring. You can't help the things that you're interested in. And for me, as it turns out, for reasons that I cannot help, I'm deeply interested in, I am convinced that I can help improve the state of affairs at companies or at governments or whatever. And I feel really compelled to act based on that conviction. I cannot help it. It's who I am. And so for, starting a long number of years ago, when I was at a firm that I won't name, I started making investments in companies where I felt I could move the needle from an ESG perspective, and I can talk about that in detail, and had a meaningful amount of success. And that sort of has encouraged me to go down this path. And I can talk about like sort of how it all started.
I would love to hear that. I want to just take a moment really quick, though, and unpack something before we delve into that. And that's, what does ESG investing mean to you? I think what's interesting is that it's, again, a term that where the example you gave, they're so focused on the E that the S and the G maybe, I don't want to say overlooked, but we're obviously much lower priorities. Does an investment fund need to balance all three, or is it okay if it balances prioritizes some of the criteria, let's say the environmental or social over others, or is it mainly about being transparent to the investors so they know what they're getting into? What's your thought about all that?
I think it's all of the above. I think ESG investing is basically about putting the world on a more sustainable course and making the world a better place, or at least stopping its continued deterioration or erosion. I think that whether the E or the S or the G need to be emphasized, I think really depends on the specific investments that one makes. And I think that fundamentally for me, that means that proper ESG has to be a micro rather than macro consideration. So I do think that all of these databases with carbon capture and carbon emission or whatever, measuring data that are inconsistent, using inconsistent processes across companies that have different ways of reporting things, just is a whole bunch of hoopla. And I'm not sure that for me, that's what's going to make the world a better place. I think that what makes the world a better place is, so I think ESG investing is investing towards positive change on any of those criteria. And I think that for most corporations, any or all of them have room for important and often dramatic improvement. And I think that anybody who proactively works to move the needle is, in my estimation, to be commended and is, winning a fight for humanity. And there are a lot of fights that I think we need to win just now, particularly from an ESG perspective. So that's what it means for me.
Thank you very much. I think it's just, there's just so much confusion.
Well, people are trying to make a very complicated matter into simple and bite-sized and one-size solution fits all consideration. And it actually defies logic. That clearly should not be path that we go on. And yet that is the path that people want to go on because, they can make money at it. They can sell solutions that are quote unquote scalable and comparable, which of course is no such thing. Or, they can market their fund as an ESG fund without having to really put in a lot of effort studying every company because these companies have low carbon footprint. I mean, again, complete waste of time. But people want to simplify it, make it scalable because simple and scalable means profitable.
Tell me a little bit about some of the success stories you've had.
Yeah. Amanda, you have no idea how many friends I've lost saying these things. And I promised myself I would be muted before talking about it ever again, but I seem to be getting more worked up about it over time. So for me, it all started with Petrobras. At the beginning of this century, had discovered all of this oil in the Santos Basin off of Brazil. And this was a huge discovery, perhaps, the largest oil discovery of this century, I think, so far, outside of shale oil in North America. Traditional oil, biggest discovery of this century. And we've done a lot in natural resources. And Petrobras wanted to take all that oil, pump it through a pipeline across the Amazon into North America. Two problems. One is pipelines leak. The longer they are and the longer they're in operation, the more they will leak all over the place. It's just statistically. And crossing the Amazon, clear-cutting a path for an oil pipeline across that part of the world, just environmentally is a big affront, I think, to humanity. Having been to the Amazon and at the sound of risking, sort of like I might, belong on a commune from the 60s, I lived with an Achuar tribe in the Amazon. And I think that until you've been there and you've experienced the Amazon, you cannot understand how important that is to the global ecosystem and to production of oxygen and to the regulation of temperature and winds and et cetera, on this planet just now. People just don't understand. So the Amazon really is, from my perspective, the most precious part of this planet. And the idea of a pipeline being rolled out across it was a great affront, I felt, to humanity. So it was an environmental disaster, and there were a whole bunch of white papers that had already been compiled showing what an environmental disaster it was destined to be. But then on top of that, because investors don't care about the environment, it's all about, returns and returns this quarter. That's just the sad truth. On top of that, it was never going to earn an economic return. It just was not an economically viable project. But they were going ahead with it anyway because this was a way for Brazil and the board of that company and that company to become a major player in international energy markets, right? So a much more prestigious kind of gig than the one they were in, which was basically a Brazilian operator. And so that's why they were going ahead with it. Well, we basically compiled all the white papers showing that it was going to be A, an environmental disaster, and then B, that it wasn't going to earn an economic return. And the work had already been done for us. If it hadn't, we would have done it ourselves. And basically went to the company's larger shareholders and said, look, they're doing this pipeline. A, it's going to cost you a whole bunch of money. It's not going to make returns. B, it's an environmental disaster. Would you consider addressing the board and telling them that you're going to vote against their re-election every year until they're all voted out if they go ahead with this. We cannot tell you what to do. Let's not have an agreement between us on how to vote because we didn't want to form a group. But this is what we think makes sense for both economic and environmental reasons. And we and a number of their largest investors basically ended up sending a letter to the board quietly saying, if you do go ahead with this pipeline, we're going to publicly vote and with great voice vote against your reappointment to this board every year until you're all voted out. And we're going to publicly talk about what an environmental disaster you are and how badly this board is managed. And within 2 weeks of us sending these letters, the company announced that it would not build that pipeline. And that was awesome. And I was so thrilled with that decision. And, now I think I can I can produce all the waste that I want because I've earned my keep, from a carbon footprint perspective. I perversely, started thinking that a little bit, but that was the first thing that we did that I was really, really grateful for the outcome of.
That's an amazing story. I feel like activist investors kind of get a bad rep, just like lobbyists get a bad rep. What do you feel about that?
No, geez, Amanda, this took a much darker turn than I expected. No, I think activist investors fundamentally, look, if my peers are wired the way I am, I think we're the kind of people who look at problems and can't help but A, come up with a solution, and then B, be like, this solution makes so much sense. I need to be a part of this. I need to make this change happen. And I think that we are fundamentally agents of change. Now, I think that some activists, the adage that comes to mind is to a hammer, every problem looks like a nail. Activist funds are basically financial institutions. And fundamentally what we do as much as anything else is look for companies that are really undervalued. So for most activists, when you look at an undervalued company, the easiest thing and your first impulse is, well, let's just put the company up for sale, or let's put divisions up for sale, or let's get it to do a share buyback. Like, it's basically have a financial patch that creates returns, but doesn't address whatever the underlying problems are that got the company to be inexpensive, usually on depressed earnings to begin with. And so activist investors are financial institutions that usually mostly only come up with financial answers to the problems at hand. And I think that's intellectually often pretty lazy, but I don't think it's a bad thing. I think that we're agents of change. And I think that one of the biggest problems we have in the world and have had for as long as we've been around, I suspect, is just apathy. I mean, I would rather work with an activist investor than another sort of apathetic, not engaged. I have too many companies in my portfolio to particularly care about any one of them, investor.
Kind of a debate when it comes to ESG investing about divestment versus engagement. How do you see those tools? I see them as different tools being applicable in different situations. I mean, how do you think about that? Because there's this, I think, great debate too about if you want to be an ESG fund, you need to avoid or divest of certain things. And we've seen examples of that, right? With maybe some big university endowments where they put in those investment policies of kind of divestment and come under some scrutiny. I don't know. I mean, what are your thoughts?
Yeah. Well, look, I feel like I should preface any answer that I give to, please forgive me for the opinions I'm going to share, because it's bound to offend someone that I really don't want to offend. But I cannot help but think that divestment is a symptom of intellectual laziness. It really is. It's kind of like, so the analogy for me would be, and I really do apologize to people who and I'm very happy to be wrong, but this is my opinion. I think that, to me, divestment is kind of like a teacher, who runs a class, and in that class there are 30 students, and 10 of the students are great, exemplary, teacher favorites. 10 of them are fine, engaged, but not that much, and certainly not problematic. And 10 of them are problematic, put spitballs in their pens and throw it at the nerds up front, which, I was a nerd. So, certainly grew up with a lot of spitballs accumulating in my hair, and just generally behave very poorly and make the experience really unpleasant for the rest of the group. Let's say those are the companies that, from an ESG perspective, would not be performing well, and where the board and management team don't really care at all, and you can tell. Okay. Divestment is tantamount in this scenario to the teacher saying, you know what? I'm only going to pay attention to the 20 kids who are doing a good job, and I'm going to completely ignore the 10 kids who, aren't doing well, aren't doing their part, and are making the experience miserable for everyone. Well, what that does is it kind of really creates a nefarious environment for all kids involved. And the 10 kids who are not engaged with, they feel emboldened to do even worse things, right? So I think that a good teacher would, in that case, probably focus more on the 10 kids who really, need help or need improvement or have some kind of problem, probably at home, that can be addressed. And if addressed, would change them, set their life on a new course, and blah, blah. So I think a divestment is kind of like the teacher who says, you know what, you're a bad kid, I don't want to talk to you, and hoping that kind of changes things for everybody involved. It doesn't. It makes things worse. I think divestment is one of the biggest problems that we have in the ESG space. I think the only reason people think divestment is a sound strategy is because they refuse to really think things through. What happens in a world where every oil company is owned not by active investors like myself, but by passive investors like BlackRock that have a 95% track record of backing everything that management and the board says, okay? A board like that has no investor on it to police it, all of a sudden the conscience goes away. You can do the things that you want to do. What are you worried about an investor coming in, publicly naming and shaming you for your nefarious practices? Of course you're not going to do that. Greenpeace can come in and do whatever they want. You hire a PR firm and you can minimize their impact, and you can put a whole bunch of misinformation out there and you can neutralize things that way. But when you have an investor in your midst who polices you and who comes in, threatens to organize other investors to hold you accountable for your environmental misdeeds, that I think makes a really big difference. And the fact is, a second reason why I think divestment is the height of folly is we live in a world where people still use hydrocarbon energy, right? I mean, unless you don't, this is one of the most important, still the most important industry in the world, actually, if I really think about it, right? And we use metals and minerals and extractive resources that are extractive from this planet. And these are considered dirty divestment industries by, people who pursue a divestment strategy. And the problem, again, is there's so much room for improvement in terms of environmental impact at these companies that divesting is precisely the wrong thing to do. You got to double down. Imagine an Exxon board that is owned by environmentalists. Okay, now imagine an Exxon board that's owned by people who don't care about the environment. That's kind of where we are now, right? So I think divestment is, I'm not going to use the adjective that comes to mind because I think I've been offensive enough. And again, I apologize for being offensive, but these are strong beliefs that I have. I think divestment just makes no sense to anybody who takes 5 minutes to actually think about it.
I love your candor, and I think it's good that we've had, on this podcast, I think multiple investment professionals.
My marketing colleagues are going to kill me.
No, I'm sure you're going to make new friends too.
It's just a fact. At the end of the day, in my experience, the facts ultimately surface and come, and this is exactly, I would be willing to bet pretty good money that 5 years or however many years from now, this will be like standard thought process, They're
going to come around when they see exactly in 5 years when they're like, James is right.
and also they're going to be like, James who? And that's just great. That's just fine.
James, I was wondering if you have any advice for issuing companies when they're of how to approach investor engagements when they have an investor as passionate and involved as you. What are some recommendations you have? What would you suggest to them?
I think not only for companies, but I think for investors and for all parties involved, I think humility and candor. I have strong views. I'm very happy to be proven wrong on any of my views. It doesn't matter if the view is mine or not, but what matters is that my understanding of the world is correct, and that I act based on a correct understanding of the world. So if I'm incorrect in my understanding or analysis, I want to understand that and I want to learn that. And I think that the best way to do that really quickly is to be really humble. And I really hope that I am humble personally and certainly intellectually. So I think humility goes a very long way. And I actually think that's one of the biggest problems because a lot of these companies, management teams and boards feel that they know their company and their industry much better than any investor does. And I think that that is the starting assumption. And I think it's a misassumption, and it's a false assumption in many, many cases. And I think that is indeed the assumption that is adhered to. It usually erodes the conversation over time, particularly when management and the board are doing things that demonstrably are wrong and that the investor has done a lot of work to prove, and that usually leads to confrontation. So I think that humility and intellectual rigor and candor would be the three most important traits to think about when engaging in dialogue with investors in general, but also from investors to companies. This is not a one-sided thing. I also think that there are many instances when activist investors show up and tell a company to do something that absolutely is not in the company's best interest. And I think that, so I certainly don't think that activists always have the upper hand. I won't name there's an activist investor who's very well known in a part of the world that we really focus on, which is Europe, and I won't say who they are and what the company was, but a number of years ago, just ahead of a material and pretty evident slowdown in the economy and the underlying market that a company was operating in, they went to a company that had a lot of cash saved up, waiting for a downturn so they could consolidate the market. They were like, you need to do a share buyback with that cash. And that share buyback would have led to a 10% pop in the share price, which is what the activist wanted, but it would have deprived the company from a not generational, but once every decade or 2 decade opportunity to consolidate the market at attractive prices. So it would have been a mildly compelling thing to do short term, but it would have come at a very, very big opportunity cost in the medium and long term. And the company ultimately refused to do it. And I felt really compelled to publicly speak out in the company's favor, because I think that activists like this who are short-termists really give all of us a pretty bad reputation. We make really long-term investments in the companies we invest in. And by the way, in most of or nearly all of our companies, we see eye to eye with management teams and the boards. And so just because we're activists doesn't mean that our exchanges aren't really positive and fruitful and super respectful.
I think you just brought up something else, of this idea of what are the timelines that different stakeholders have in mind. And it really can influence what they're pushing for, right? If it's a very short-term timeline they're thinking about versus a long-term investor like yourselves, it can result in very different suggestions or approaches to the business to get that quick return. Or is there an opportunity that requires patience?
Yeah, Amanda, I really think that's another really big topic that we don't spend nearly enough time talking about. I've been doing this since the mid-90s. And I remember when I first started investing in Europe in the mid-90s, you would get 2 results per annum. You would get like half-year results, and then you would get full-year results. And the half-year results were just basically like revenues. It wasn't a full P&L. And so there was that process naturally invited a much longer-term view of the company and its prospects. And you didn't feel like you had to react to quarterly results. And then the tech bubble of 99-2000 really, really screwed up the world, I think, of investing, because what you saw companies do is they wanted to report as quickly as possible the revenue growth, because everybody was being rewarded these outrageous multiples on revenue growth. And of course, they were growing because the internet was in its nascency. And so you started to see companies around the world report quarterly results. And all of a sudden, you started to see a lot more trading around. And now we're in a world where people just trade. They don't even invest. Like, you go on Twitter, people don't even pretend to be investors. They're like, the trading is so difficult in these markets. Well, the markets weren't meant to be traded in. They're meant for investors. And I think that our short-term, the collapse of the time frame that we keep in mind for our investments, from a yearly one to a quarterly one, I think has had unbelievably disastrous consequences on companies and their ability to commit to long-term projects. And I think on us as human beings as well. And it's a topic people don't think about. And I would love it if we move to a world where companies reported results every year, because then we would be investing, not trading. And I think trading is not fundamentally a useful human activity. It doesn't really add much to the world.
One question kind of connected with that I have for you is, we're talking about, publicly reporting financial results, right? And currently in the world of sustainability or ESG reporting is typically done on an annual basis. Sometimes you'll get a little tidbit here and there, but it's not mandatory. It's not regulated, at least in the US,
Yeah.
But there's also complaints from investors just overall that they're not, maybe I shouldn't say complaints, but demands for greater transparency and more information and more accurate information, higher quality data. Do you
Yeah.
feel the same way around environmental or safety or diversity or other ESG metrics as the same? Is annual reporting, if it's high quality, done accurately, is that sufficient, or should companies also think about if they really are embracing ESG and have embedded it, should they consider reporting more frequently than once a year? Any thoughts on that?
Yeah, but I'm not sure that again, the voice inside my head says, don't say this, but I really think that, but that poor voice never has its way. I really think that all of that data at the end of the day for me is of pretty limited value. I think that issues around diversity, I think that it depends on the topic at hand. I think that around diversity, yes, it would be very useful because there really has been discrimination against this topic. I feel really strongly about women, for example. Like when I went to high school and university, the smartest kids in class were always the girls. Always. Why? They develop earlier. They seem more emotionally mature than we are. And then we men have over centuries created this whole narrative that actually we're the emotionally stable ones and women are not. I really do think it's the other way around. Like, this is my experience. Again, I'm going to lose a lot of friends over this, but they're not going to tell me why. But I know that that's coming. And so the fact that women have not been equal participants in the workforce, I think, reflects some biological truths. I mean, at the end of the day, if you take time out to raise your kids, which is probably the most worthwhile thing one can do with their lives, at a time when at the most crucial or formative period in your career, that I think is a big chunk of the reason why women haven't advanced as much. And then that leads us to look at, well, what about Scandinavia, where men take father's leave, to take care of their kids? And that seems to have worked out very well. And that's one of the most cohesive and functional and successful societies that humanity has come up with so far. I think that it really depends on the topic, and data points are particularly important for certain topics versus others. On the issue of diversity, though, another view I would have, which again is going to lose me whoever I haven't lost already on this call, is doesn't make sense to hire people just because of the color of their skin or their sexual orientation or their gender if they're not the most competent person for the job at hand. And how great is it to impose such a view on companies who have a candidate that's really great for the job, but they're like, yeah, sorry, you're just not the right color. Isn't that a form of racism itself? So I think these are some really complicated questions. I think that ultimately, I think for me, common sense should rule the day, but there's someone pretty quotable whose name I forget who said there's nothing so rare as common sense. So I think it really depends on the data, but I think that the data obfuscates and hides the bigger point, which is any investor who actually really cares about having an impact looks at and hires experts who know an underlying company and its operations really well, with a view to understand where does this company have the greatest room for development and for improvement, and why, and how do we do that? Is it a company that really has diversity issues? Is it a company that, is an industrial operator that could be adopting much more environmentally benign production practices, but it isn't because they're new and maybe unproven a little bit, and there's reluctance to adopt these things. So I think that at the end of the day, I think that focusing on specific, a war isn't won with one battle. A war is won many little battles and many little places all around the world. And I think that ESG is kind of like a war. And I think that we as investors have a lot of little battles to win. Can I make this gold mining company, treat the local indigenous population a little bit better, which, by the way, means that there would be fewer interruptions of their operations going forward. So a lot of times ESG has positive economic benefits as well. Or could I get this company which makes diapers, which are a terribly difficult thing to recycle? Can I make them use, organic material and organic plastics, which would be a miracle? Or can I get, and so there's a number of little things like that one can and should focus on, I think, that would actually really move the needle if we all did it in our own little way. The greatest changes and the greatest advances are made little by little all around the world and in conjunction. And so let's each of us pick our own little battle and win it rather than passively invest based on data that ultimately, it reminds me of the Shakespeare quote, tale told by an idiot, full of sound and fury, signifying nothing. And I think that all of this data and this data set is better than that. It's more reliable. And ultimately, does it really improve the world? Not at all. I don't think.
James, it's been wonderful talking with you, and I so appreciate your sharing your opinions and your candor about your ideas. If you've made some friends, new friends from this podcast, how can they connect with you?
Well, you and I both know that that's not happened unless there's like Greenpeace listeners, shout out, I'm a fan. And I know that's going to lose like the one person who I haven't lost yet. But I'm on Twitter and I'm on LinkedIn, and those are good places to reach us. I have two partners who are incomparably more thoughtful and intelligent and great, and they're both on LinkedIn as well. So we're delighted to engage.
Thank you, James.
Thank you.
Thank you for listening to ESG Decoded. Subscribe to this podcast wherever you consume yours, and follow ESG Decoded and ClimeCo across social media platforms. Until our next episode, take what you learned today to drive long-term value for your organization by doing good for people and the planet.